You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble. His website is dollarcollapse.com. Welcome to the show, John.
Hey, Jim. Good to talk to you.
We keep talking about Greece, a little country that usually doesn't get mentioned a lot unless you're talking about tourism or Retsina. But now, perhaps they have a deal that will keep them solvent?
Well, the news this morning is that Germany's considering offering them a deal in which, Germany largely caved. They're going to ask for one reform out of the many that they've been asking for up front, with the others to come later in return for bailout money that keeps Greece from defaulting and leaving the Eurozone and aligning itself with Russia, all the things it's been threatening. And this is the kind of thing that was inevitable one way or another, because the Eurozone was not going to let Greece leave lightly, because it's potentially a really disruptive thing for the common currency. And Greece's numbers are really rounding errors from the point of view of the European Central Bank's quantitative easing program. They could buy Greece with the amount of money that they're creating. So there was never any doubt that if it came to it, Europe would find the money to keep Greece in the Eurozone. And that's what it looks like is happening right now. And so the financial markets like this, or at least the stock markets like this. The U.S. stocks are up 250 points on the Dow today, and I assume, most other markets are responding favorably to it because it removes this big source of risk. At the same time, interest rates are going up now because, especially in the more or less safe markets, money has been pouring into government bonds and high-grade corporate bonds as a safe haven against the possibility of financial disruption from Greece and other black bonds that are clearly out there. And so if that money's flowing back out of the bond market, causing rates to go up, and flowing into equities, causing equities to go up, that's a fairly logical thing. But, of course, equities are already grossly overvalued by most historical measures. So it remains to be seen whether it's smart for the people who are leaving the bond market and getting into stocks right now. But that seems to be the dynamic. That's what's happening out there.
Why would interest rates be going up at a time when they say economies all over the place are still pretty wobbly?
Yeah, the dynamic just a month or two ago was that the world's major economies were slowing down. We were heading back into either a recession or something close to that in the U.S. Europe was flat on its back, and China had a credit crisis, and Japan is a demographic mess and can't grow, and all of that. So slow growth in the face of massive debts had the markets nervous and worried about the disruption that would inevitably result if especially a big economy like the U.S. dropped into recession. And so people were worried about return of capital rather than return on capital. They were willing to buy even really, really low-yielding bonds, like negative yield bonds in the case of Switzerland and Germany. And that was why interest rates were so low. So if people are less worried now because they assume remove Greece from the equation and the world's central banks can lean against a recession by creating more currency and doing more quantitative easing, et cetera, and you get a little cockier and are more willing to reach for capital gains in the stock market. And that's what the financial markets are doing right now. Now, see, none of this is good because we continue to increase the amount of debt in the world past what are already debilitating levels. What were debilitating levels back in, 2000, and they've only grown dramatically from there. So all of this stuff is dysfunctional and going to blow up at some point. But in the meantime, you get these squiggles that go on for 6 months or a year in which one sector or another sector is favored. And that's what's happening now. Over the last few months, we've seen a shift of money from super safe bonds into more aggressive equities. And that's, it's a risk-on trade, and it might push the price of assets up from here. but it'll do so at the cost of increasing instability as asset prices get more and more untenable at these higher levels.
I mean, everybody keeps saying, when are we going to get this major correction? We have a market that's 2 years overdue for one.
Yeah. Oh, yeah. Yeah. At least in the U.S., equity prices have never gone up this steadily for this long. And the reason for it is because this is a new equity market in which governments are major players. And they don't much care about fundamentals or even technicals. You know, they're just buying because they have the money. They want to push up prices. And so equity prices have become a public policy tool where governments try to raise the value of the investment portfolios out there in the hope that people who feel richer will spend more money and borrow more money, and the economy growing in that way. And so this is uncharted territory. We've never had the governments distorting this many formerly free markets in the interest of public policy goals. And economic theory, at least good economic theory like the Austrians, say that this will distort the pricing mechanism that is at the core of free markets and lead people to make bad decisions because they're misreading the prices that they see out there because governments are distorting those prices. And so you get malinvestment. In other words, money that's been thrown at stuff that isn't in the long run profitable, doesn't generate the cash flow needed to pay off the debts that you take on to start the project, and then eventually defaults. So you get huge amounts of embedded malinvestment out there, which is going to blow up on us. And the question becomes when. You know, how long can governments keep this going? And we don't know that because we've never been here before. Governments have never, on a vast scale like today, intervened in the financial markets. You know,
and then, of course, you have the Canadian
you know.
pension plan is heavily invested in the stock market. So it's in the Canadian government's interest to keep stocks going up.
Yeah, that's a big part of it. Now that pension funds are so exposed to risky assets, you can't have a typical 20% garden variety bear market without affecting public finances on a dramatic scale. And so governments are kind of in a box now. They really don't have a choice but to keep liquefying the markets, but to keep printing new money and sending it out into the banking system and the stock market and the real estate markets. You know, the old phrase "inflate or die" has been around for a while, but now it's more true than ever. Governments can't stop, and because of that, they won't stop until the markets force them to. And since they're in control of the markets, we could get even more dramatically out of whack asset prices before this thing ends. Or it could happen tomorrow. There's really no way to know because again, this is uncharted territory. So it'll blow up.
And people get itchy feet or itchy fingers or whatever because so many people thought the market by now would be into a major correction and they went to cash. Well, they've been sitting on top of this cash. It's not making money on interest. So they're throwing it back into the market again.
Yeah. You know, somebody with cash has a real dilemma because you don't earn anything on it, but you don't lose anything on it in the short run either. But if you want to generate returns with your cash, you have to put it somewhere, and everywhere is looking increasingly risky. You know, government bonds, as James Grant said, are now return-free risk. You know, you can only lose in a government bond that's yielding zero. And stocks are at levels that historically have preceded major bear markets in terms of valuation. And real estate, especially trophy real estate, is being bid up everywhere. You know, you guys in Vancouver are looking at a rip-roaring real estate bubble, you know, which is as big as the one that you saw in 2006, 2007. And it's all that Chinese money coming in, right? That's what's driving the Chinese stock market to bubble levels, and it's also driving asset prices around the world. There are an awful lot of new Chinese millionaires and billionaires who are looking to get money out of the country.
Well, and also, if they want to have an extra child, they have to invest so much money in foreign real estate. That's how the deal works.
And all of these things are distortions of what should be a free market, where people are rationally investing capital in the hopes of long-term positive returns. That's not a lot of what's going on now. People with extra money in China are worried about what's going to happen going forward in China. So they just want their money out of the country. And they're willing to accept extremely low returns or even negative returns on a Vancouver or a London or a New York City condo, for instance, because at least they're in a place where the government isn't just going to swoop in and impose capital controls and wealth taxes. Of course, they may be wrong about that. We could see that in the developed world as well when things start to spin out of control. But it's, from their point of view, less likely in the short run here than there. And so same thing in Latin America. There rich people in Brazil and Argentina and Venezuela are buying Miami condos as sort of a vault in which to put their cash. They're not thinking of it as, I'll go there for 6 months a year and live in Miami, or, it'll go up and then I'll cash it out at a profit 5 years from now. They're not thinking about that. They're thinking, I will always have this asset. No matter what happens to me back home, I'll have this thing that I can, that will have some value and that will still be subject to the rule of law and where contracts will still be, valued and respected. And so it's not really that important to them what they pay. What's important is that it's going to be worth something and it's going to be accessible for the foreseeable future.
And in Miami, they can't seize your house if you owe a debt. That's a unique thing about Florida real estate.
Not yet.
Yeah,
so you're protected to an extent by law in the U.S. in ways that you may not be going forward in a lot of these other countries. And so that leads a lot of capital to flow into the U.S. and into Canada and into the more stable European countries. And so that's bidding up asset prices, but it's bidding them up to levels that don't make any sense. And so even though this is a new dynamic with a lot of new money coming in, it's in another way a very old dynamic. Things go up beyond rational value. And everybody starts to think that maybe our old valuation measures are wrong, but what's really happening is that the final fools are buying money. The final dumb money is flowing in. And that's leading to the final blow-off stage of an asset bubble, which then pops, and then everybody feels kind of stupid that they got in at the top. And I think that's more of a human nature thing. It doesn't matter who the players are. It doesn't matter if it's governments or if it's corporations buying back their stock or individuals mortgaging their houses to buy equities. These are things that happen at the tops of bubbles, and this bubble will burst. And the only question is when. If interest rates spike from here, for instance, that would be the kind of thing that would crack the stock market. And so that could be the thing we're looking at now. Interest rates are up dramatically in most major markets. In the U.S., the 30-year Treasury bond was yielding 2.25% in January. Now it's close to 3.25%, and that's a huge move in percentage terms. That's nearly a 1/3 move in the yield on these bonds, which means, because the price is the reciprocal of the yield, that means the price of these bonds has gotten crushed in the last 6 months. So you've got a lot of recent bond buyers who are now underwater, and we'll have to see how they behave. And all of this is too many moving parts to really predict anything with certainty, but there's a lot of stuff that can go wrong when things get this crazy.
We'll have more with John Rubino right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with John Rubino, author of several books on the economy, including The Money Bubble. Well, John, a bubble we were talking about before we went on air was the Asian markets, and China is still going crazy.
Yeah. The Chinese stock market, they liberalized some of the rules. for individuals to be able to invest in it. And so there's this huge amount of money flowing into Chinese stocks with hundreds of thousands and millions of new people who've never had brokerage accounts before opening their brokerage accounts and investing in Chinese stocks. So they've gone parabolic. China's bull market looks like the blow-off phase of the tech bubble back in 1999, early 2000. And so it's not clear that it can continue much from here because valuations are getting really out of whack again. And so it depends on how much new money is created by the Bank of China and pushed into the market because China's economy is slowing down and they're looking for ways to liquefy the system and to ease financial restrictions and hope to get the economy growing in that way because they don't want to break the link between the dollar and the Chinese currency, the yuan. And because of that, the yuan has gone up along with the dollar in the last year, which has slowed Chinese exports to the rest of the world because their stuff is suddenly more expensive. Their currency is more valuable. And that slowed the economy down. That's still an export-driven economy. So they've got some problems, which they're trying to address by liberalizing financial rules and by creating a lot of new yuan, pushing it out in the market. And that's leading to asset bubbles. Chinese billionaires are running around the world buying all kinds of assets, and Chinese individuals are buying stocks, and so the net result is extreme instability. A lot of really profound capital flows within China and leaving China. And again, we don't know how it ends in the short run, but it must end badly in the long run because these numbers are just too big and the valuations are too out of whack, too historically unusual for them to continue. So they are.
Well, in Vancouver, where they have high real estate prices that are going up every day, there's now a big concern that the city will have a labor shortage simply because people who work here can't afford to live here.
Yeah, in these booming cities, how do you live near your school if you're a teacher, or in your precinct if you're a cop? You really can't do that when rents are soaring along with home prices, unless you've already bought a house years ago and you have all these capital gains that are embedded. Maybe you can sell and use the capital gains to downsize within your area, but that's unusual. Most people who don't make a lot of money are negatively impacted by real estate booms within cities. And so, how do you run a city if all of your employees can't live there? That's something that is pretty common at the peak of real estate bubbles. And it's a shame that it keeps happening over and over again because it doesn't end well. It doesn't end up helping people or anything. It just ends up shifting ownership of these assets from one group of people to another and then to the third group when the second group all goes bankrupt, and just causes a lot of turmoil. So I don't know what you do in Vancouver if you're someone trying to run the city government or if you're a government employee because all this Chinese money is just making the cost of living go crazy there. And it's not just Vancouver, but Vancouver is one of the real beneficiaries because that's a city that the Chinese understand. It's close enough, or not close enough, but it's on the right side of the continent for Chinese to be able to travel there relatively conveniently. And there's a huge Chinese-Canadian community already in Vancouver. So it makes it a super attractive, and it's just a great city, so it's really attractive for rich Chinese. And you're seeing the results of that.
Well, I talked to a group of high school students, Chinese girls in grade 11 who were born in Vancouver, and they could barely speak English. And they said, well, we should work on our English, but frankly, you don't need to speak English in Vancouver anymore. And they were really that blunt about it.
Wow, that is amazing. So now you'll have a third language, English, French, and Chinese.
Not a lot of French in Vancouver.
No, but in Canada,
Yeah.
There'll be, some very big cultural issues to deal with going forward.
In the suburb of Richmond, a lot of blocks where the only language you'll see on a sign is Chinese.
Yeah. And, they're bringing lots of money with them. So in that sense, it's a very positive thing. But,
well, take a look at Japan where they don't want immigration and they're literally dying out.
Yeah, the downside of Japan's homogeneous culture is that unless their birth rate at least exceeds the replacement rate, they shrink down to next to nothing, and that's their trajectory. That's Japan's big problem. Is they borrowed huge amounts of money, and now all the people who were workers up till now, paying off the debt, are now retiring, and they're drawing down on their savings. So there isn't the domestic money left to cover the cost of this huge retiring generation. And so what do? They're automating. They're going to be the most advanced robotic-based society going forward. But I don't think that'll do it. I don't think that will save them. So they have a huge demographic/financial time bomb that's going to go off at some point.
And yet you have all those other countries where people are risking their lives in leaky boats to get away from poor economic conditions. Japan should be welcoming those people. They'd work hard. Take a look at Canada and the U.S. Immigration has driven our economies for over 100 years.
Yeah. And at a certain level, immigration is a really, really good thing. Because, like you said, people who come here from turmoil, from really dysfunctional countries, are usually pretty good citizens because they appreciate it. We take for granted a lot of the stuff that we see around us. Systems that work, cops that are more or less your friend, and city governments that actually respond to requests for help. Stuff like that is a novelty to people who come here from Africa or the Middle East or from parts of Latin America, and from parts of Asia. And so they tend to come here, work hard, keep their kids out of trouble in general, and they're good citizens, and they're a net plus for the economy, up to a point. You can't have immigration at such a level that it destabilizes the society, and that's kind of what we're wrestling with in the U.S., where too many people have come in especially in the Southwest, for governments there to feel like they can function well, and so the turmoil because of that. And Europe has some issues with immigration that we don't need to get into now, but that a lot of them perceive as problems. But done right, immigration is a great thing. So it's just a question of getting it right. And Japan's at the other end of the spectrum, where they're suffering from too little immigration, and they're not sure how to deal with it because they are more mistrustful of foreigners who are very different from them than the countries that have traditionally been kind of melting pots. So,
until the Great White Fleet showed up, the American Navy in Tokyo Bay, they had banned foreigners for 1,000 years.
Yeah. That was Japan's history, and they very happily got along on their own, and so did China. And the opening to the outside world was traumatic, but was an incentive for them to modernize. And they did that well. They've done a great job of becoming a modern first world country, but now they have to figure out how to deal with the downside of being a modern first world country, which is an extremely low birth rate. All the rich countries, Japan's an extreme example, but everybody's got the same general trend going on where well-educated, fairly wealthy women have a lot fewer kids than poor women do. And so when you've got couples having one kid, or 1.5 kids. You need like 1.8 to replace your population. And when you've got the average couple having fewer kids than that, then your society's population shrinks. And Germany and Japan are extreme examples of that. Left to current trends, they will just shrink down to nothing in another 100 years. And so how do you carry the debts of your high population days into a shrinking population future? That's, we have so many financial problems. That's one of them, shrinking populations.
And in China too, with the single child policy, they have elderly parents that they're trying to support, and yet they're trying to support their own families, with a new child on the way or there already as well. And it's turning out to be very hard to do.
Yeah, China is surprisingly, because you don't normally think of a developing country as having a demographic problem, or that kind of demographic problem. Usually their demographic problem is too high a birth rate that has led to too many 19-year-old men running around, causing trouble, that's the story of the Middle East and a lot of Africa. But China's, they've tried to control their population growth for such a long time, and, by and large succeeded. But now the cost is lots of retirees who have one kid or no kids supporting them, and public finances that are really overburdened by that. So it's something without an obvious solution to a lot of these countries, although immigration is the obvious solution. And you take some of those 19, 20-year-old guys from other countries and then bring them in and put them to work for the next 40 years. And in that way, they support you in your retirement. But, there are cultural issues with that.
Well, and old people hate change as well. And with these older people...
You're living in a world full of young foreigners in your neighborhood, and that's scary to a lot of people. I get it. There aren't easy solutions to these things. But, and in some cases there aren't any solutions at all, to the amount of debt that we've taken on. There's nothing you can do that isn't traumatic. There's no way out of this. And so we have a decade of really wrenching change coming. And our only choices are, among really difficult kinds of change. So when the economies of the world slow down, then all the stuff that you and I have been talking about, asset bubbles and demographic issues, all of that stuff will become front page news. Because right now, increasing asset prices and easy money, low interest rates, you can paper over a lot of problems with stuff like that, because that allows people to borrow and buy stuff, and so for at least a little while you get growth. But that has a limited time frame in which to operate. And when it stops operating, when you can't push interest rates down any further, when you can't push asset prices up any further, that process grinds to a halt. And then all of this other stuff starts to loom large, because all of a sudden these problems that you could paper over with easy money become serious. They become front page news, and they become terrifying. And so that's our decade. That's what we're looking at when easy money stops working, and all this other stuff has to be dealt with up front, flat out, without the excuse and the drug of easy money. And a lot of these problems are going to turn out to be intractable. We just won't be able to fix them with policies from the menu of historically possible. So we'll have to get way, way outside the box. And that's going to be really uncomfortable for a lot of people. And it's going to be really, really traumatic financially for a lot of people. They're going to end up losing money in the things that they thought were safe, and losing a lot of money in the things where they were stretching for yield and return.
Think outside the box. I think we're going to end up living in cardboard boxes.
Yeah, well, yeah. And so you really don't want to be a pension fund manager going forward, or an individual trying to save money for retirement. These are hard things to do in this kind of turmoil, because the old simple ideas of a standard cookbook mix of stocks and bonds and cash are going to be catastrophically dangerous in the next few years. And yet that's where most people are. That's where most pension funds are. If anything, they're a lot more aggressive now than they were a decade ago, and so they're even more at risk from the kind of volatility and turmoil that you necessarily have to see after a debt bench like this. And individuals, the average guy who's saving for retirement, he doesn't know how to quantify the risks from excessive debt and asset prices that are out of whack. He just knows that his financial planner told him to buy this growth stock fund and buy this international bond fund and keep some money in cash in the bank, and that's what he's doing. He doesn't realize that all of that stuff could get a lot less valuable going forward. And the whole era of bank bail-ins is another issue. When banks start to fail, and instead of the government just bailing them out, they go after your bank account, take 20% off the top of your savings account. which you thought was your money, but actually is only an unsecured loan to the bank in which you've deposited it. That changes things too. And that's also coming. All of this stuff is coming. And,
well, I personally have had the experience of the bank helping themselves to bank accounts saying it's our money, not yours, and we'll do with it what we want. And that's why I'm fighting them in court, because it's pretty disappointing when you see an account emptied and you didn't touch a thing.
Yeah, see, most people think their bank account is their money. And it's actually not. It's actually money they've lent to the bank, and they don't know that. They aren't aware of it, and they think that government insurance will protect them, but the actual insurance fund, at least in the U.S., is woefully underfunded. It couldn't handle, a couple of decent-sized bank runs, let alone a nationwide banking crisis. And so the question then becomes, where does that money come from? And if the government has to print it, and that causes turmoil in the financial markets, then, in a lot of cases, governments are now choosing to just take the money out of the existing bank accounts. And so, Jim, you can really get going and just pull one thread of another after another out of this tapestry of financial mismanagement and excessive borrowing, et cetera, and then, it really starts to unravel.
And of course, when the banks do something bad, they just get a big fine that they write off at tax time, and the people who perpetrated it still remain in power. The banks can take your money and they don't go to jail, and that happened in the U.S. mortgage crisis, where they had robo-signing, your mortgage being kited at a super high rate that you didn't even sign.
Robo-signing was, that's one of the things that the regulators could understand, so it became an issue, but that was really the least of the crimes committed by the big banks in the 2000s, and being committed by the big banks on an ongoing basis now. They've pled guilty to dozens of crimes.
Sure, and who's paying at HSBC for their malfeasance? They're laying off 20,000 workers.
Yeah.
But the guys at the top who
just anybody go to jail.
Yeah.
Now, if you're running, Jamie Dimon at J.P. Morgan Chase, he's running what is essentially a criminal organization based on the number of crimes it's admitted to in the last few years. And he's a billionaire now. So that's basically the message that the government is sending to the big banks, which is, go ahead, commit any crime you want to, and we'll have to fine you every once in a while for public appearances, but just consider that cost of doing business. You can still get rich, and that's basically what's happening out there. They're paying their fines and just moving on to the next crime. So that's the kind of thing that also leads to malinvestment and to excessive leverage, because when you assume you're going to be bailed out and not held accountable for whatever you do, your impulse is to take the biggest risk possible and to bank the fees or the capital gains or whatever, safe in the knowledge that if it blows up, you will be bailed out by the government. And then you can just walk with all the bonus money that you collected and all the stock options that you cashed out, and you can go be rich. And worst case scenario, your successor has to deal with a public relations issue for a year or two. But that's it. That's the worst case. So no surprise then that we get these big, powerful banks that run the political system and structure the regulatory environment to their benefit and to the detriment of almost everybody else.
John, thanks a lot for chatting with us.
Sure, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.